Quick note before we get started on the video, if you are interested in purchasing the future CFD's daily key levels V 3.0 indicator, you can email us at daytradinggps@gmail.com to request a discount promo code to purchase lifetime access to the indicator. To purchase the indicator, go to daytradinggps.com. Hello, in today's video we'll be taking a look at the Friday, May 8, 2026 trading session for the Nasdaq NQ E-mini futures. We'll be utilizing two different indicators. One, the day trading GPS futures CFD's daily key levels V 3.0 indicator, as well as the day trading GPS ribbon indicator for confirming our entries. Okay, so this is going to be a short and condensed video. We're not going to go into all the different aspects of how this indicator works in this particular video. We're simply going to go over the trade of today, as well as the different key levels. And if you would like to know more about how this indicator works, you can look in the description of this video, and there will be a link to a previous video which we went into more detail about how the indicator works and all the details about the trading strategy and other aspects about the indicator. Okay, so as you can see, we're on a 2-minute chart. The recommended chart time frames for utilizing this indicator for either NQ or ES, so the S&P 500 ES futures or NQ Nasdaq E mini futures, is going to be between 1 minute and 5 minutes. So the majority of the time we use the 2-minute time frame, as that is the same time frame we use on SPX and NDX trading, and this is basically the same instrument just in a different form, in a futures form versus index form, in which we're utilizing options for SPX and NDX. Here we're just simply utilizing either regular E-mini futures contracts or micro futures contracts. Okay, so the way this indicator works is that we have the contextual levels here, the YDH, the PML, the PMH, the YDC, and the YDL. The YDH is yesterday's daily high during the RTH session. That is from 9:30 a.m. to 4 p.m. The YDC, yesterday's daily close for the RTH session. YDL, yesterday's low for the RTH session. The PMH is today's pre-market high, which occurs between 4 a.m. and the start of the 9:30 a.m. RTH open. And the pre-market low is the pre-market low of the same thing, 4 a.m. through the start of the 9:30 a.m. RTH open. We have market scenario 4 for today. So this indicator gives you a market structure analysis every day at the 9:30 a.m. first tick of the RTH open. For today we have top overhang poke above. With this indicator, along with your comprehensive user guide and manual that comes in a PDF, you also get a link to one-page cheat sheets for the different market scenarios. There are only 6 different market scenarios that Nasdaq E-mini futures can open up in on any given day, and those are the result of 4 different of these contextual key levels: the YDH, the YDL, the PML, and the PMH. And based on the relationship of those levels determines what one of the 6 different market scenarios that today's market structure is. The way you bring it up with this indicator directly on the chart is you simply go into the user control panel. You'll go down here, and you'll go down here to the market scenario table, and you show NY session market scenario table. It's set to normal. That's going to be fairly large on your screen to begin with, but you can change it to a smaller amount, a smaller size, excuse me, if you wish. You can even set it to a larger size if you prefer that. You can also change the position of the market scenario table as well. If you prefer not to have this market scenario table on your chart, you can simply refer to the one-page PDF cheat sheets, which you can either have on a separate monitor if you happen to have a multi-monitor setup, or you can simply download them and print them out and keep them next to your keyboard, and also study them in the off time, which we'll just briefly show you those. Okay, so here's the one-page PDF cheat sheet. It starts off with a summary page that goes over an explanation of what each market of the 6 market scenarios is. Also, an important note and risk disclaimer. Basically, that these are the dominant tendencies and key trading characteristics of the market scenarios, what is presented in the one-page cheat sheets. There's not 100%, nothing is 100% in the market. However, these are the dominant tendencies and key trading characteristics of each market scenario. And it goes to each one inside yesterday's range, full gap above, which actually means a true full gap above, where the entire pre-market high to pre-market low range is entirely above yesterday's daily high, not just the open. Full gap below, same thing, a full true gap below in which the entire pre-market range, pre-market high to pre-market low, is below yesterday's daily low, not just the open. Top overhang poke above, market scenario 4, that's what we're dealing with today. Bottom overhang poke below, market scenario 5, and the most volatile market, market scenario 6, spans both sides wide pre-market. Okay, so the one-page PDF cheat sheets have a little bit more information than what is presented here on the chart, just due to the constraints of how much room we have here on the chart to present this table. However, all the core information is the same. Some of the key aspects of this particular market scenario to pay attention to is the market often tests back down to the YDH level, as this was yesterday's high, remains a psychological level. Okay, so also it's common to see a retest of YDH. Sustainable moves require follow-through volume. Market needs to reclaim and hold above YDH during the RTH session to confirm strength. Additionally, PMH acts as initial resistance if the market moves higher. Breaking decisively above PMH with volume signals strong bullish momentum and confirms the breakout. All right, so for right now, we're going to go ahead and turn this off. All right, you can see here we have the 9:30 a.m. opening candle. We're getting the 9:30 a.m. opening candle bull bear key price level bullish entry alert here on this 9:30 a.m. opening candle. We're not going to go simply off of closes above or closes below the key levels. We are, as far as our entries being either bullish entries or bearish entries, just based on candle closes. We also have to have confirmation from the ribbon indicator. So confirmation means that we must have full confluence with the ribbon indicator being completely green on a bullish entry. Ideally, you're also looking for the top part of a ribbon on a bullish entry, not only to be all green and the entire ribbon to be all green, but for the top part of the ribbon to start to be pulling away from the base as well. On bearish entries, you're looking for the reverse. You're looking for confirmation not only that the candle close below a key level, but you're looking for the ribbon indicator to be all red. And ideally, you're looking for it to be all red in combination with the lower part of the ribbon pulling away from the base and also being all red. If the ribbon is multicolored, then that kind of negates the entry on a close above or close above or close below a key level. So you're looking for full confirmation from both the ribbon and the close above or close below the key level. Now you don't necessarily have to enter on the 9:30 a.m. opening candle. This alert is for the opening candle because there are many traders that do like to trade off of the opening candle. So if you're that kind of trader, then this is giving you your alert for that. And if you are taking this trade, then you also need to wait to make sure that you have confirmation from the ribbon. So you're waiting ideally for the candle close or near the candle close to make sure this is going to close above, in this case above, and that the ribbon is all green. You are entering on the close of the candle, and we have the price of 28,926.75 on the close of this 2-minute candle. What you're looking for after this is you have two different types of trades that you can do with this indicator and this daily key level strategy for trading futures. There are two different kinds of scalp trades that you can do. One is a micro scalp trade and the other is a regular scalp trade. The other type of trade that you can do besides a scalp trade is going to be called a regular trade. And there's two different minimum thresholds on a regular trade. On a micro scalp trade, what you're looking for is the next contextual level that is before the one level move in your favor. So a one level move in your favor that's calculated from the level that you're basing the trade on, in this case the bull bear key price level, a one level move in your favor is a regular scalp trade. So at a hit of R1 here, you would get out, or you could just go ahead and set a order to close out your trade once you've entered here, as well as your initial stop loss. Your initial stop loss is going to be the QL below the BBKPL if you prefer a tight stop loss, or the midpoint below the bull bear KPL if you prefer a standard stop loss. So you either have a tight stop loss, which on bullish trades is going to be the QL below the BBKPL. On bearish trades off the BBKPL, it's going to be the QL above the BBKPL. On bullish trades, the standard stop loss is the first midpoint below the level you're taking the trade from. In this case, it would be this level here. On bearish trades, it would be the exact opposite, the first midpoint level above. Works the same off of the other main key levels. If you take trades off of the contextual levels, you simply go into the user control panel. You go down to either the bullish or bearish trade section, and that section is here. First is the bullish entry, stop loss, and take profit levels. You have each one, pre-market low, pre-market high, YDL, YDH, and YDC. That's followed by the bearish entry section, PML, PMH, YDL, YDH, and YDC. There you would pick your standard or tight stop loss using the drop-down menu. Then you would also utilize your take profit. So you have to basically check these here. In this case, we were looking at a bullish trade off of the pre-market high, so you would hit that here, and then you could hit take profit here. The standard reward to risk is going to be 2 to 1, so that's $2 of reward for each dollar of risk. The dollar of risk is calculated from the level that you're basing the trade on to the stop loss. The reward risk multiplier goes in 0.25 increments up or down. So it goes all the way down to 0.25 if you would like to do that. The standard is going to be 2 to 1. It goes all the way up to 30 to 1. So as an example here, as we see here, we have bullish take profit, PMH, bullish standard stop loss, PMH. So if we were taking a bullish trade off the PMH instead of the bull bear key price level, and we wanted to use a standard stop loss, that would be our stop loss on a standard SL for a bull PMH trade. And then this level here would be a 2 to 1 reward to risk for that. Okay, so as we said, the regular scalp is a one level move in your favor. How does that differ from a micro scalp? A micro scalp is if there is a contextual level that precedes, as comes before the one level move in your favor in the direction of the trade, then you can use that as a level to exit on a microscalp. In this case, we have two contextual levels, the YDH and the PMH. Now the YDH here is a little close to the entry here at the 28,926.75 on the close of this opening candle. So if you were taking this opening candle trade, this is a little too close. You still could use it if you wanted to, but it is a little close. This PMH level would be fine if you wanted to use that as your scalp only exit. And as we saw in the market scenario analysis, the PMH is a critical level for today in this particular market structure. So there's a high likelihood that it's at least going to get tested. Now, as you can see here, what we did have happening after the 9:30 a.m. opening candle is we get a move above the YDH, and then we get a next candle, and then the next candle hits the PMH, and then we come back down here to touch, if we can zoom in here, we go above YDH, we come back down, we go up and test PMH, then we come all the way back down to test YDH. Now, if you remember from our market scenario analysis, we'll just go back and look at that very quickly again. Market needs to reclaim and hold above YDH during RTH to confirm strength. Common to see a retest of YDH as new support. So that's exactly what we see here. Breaks above, comes back down, tests it, comes back down and tests it. We also have PMH acting as initial resistance. Breaking decisively with volume signals strong bullish momentum and confirms the breakout. So that's what we finally get here. So this is kind of a textbook example of this particular market structure scenario. So you have several different trade opportunities here. You have the opening candle opportunity. You have the close above YDH, so you could take a bullish trade off of YDH because what is happening? The ribbon is also green. The ribbon is completely green and it is pulling away. The upper bands are pulling away. So you don't necessarily have to take this as your entry here. For those that like taking the 9:30 a.m. opening candle entry, this is your entry signal and this is your confirmation with the ribbon. You could also enter here or here or here. So you could also enter on the PM at close above the PMH and make the PMH your level that the trade is based off of. You could also make YDH the level that your trade is based off of. And you would simply use the stop loss, either a tight or standard stop loss, in the user control panel. For those taking the opening candle BBKPL trade, then you're taking the close of this candle here, and then you're using either the tight stop loss to QL below or the standard stop loss, the first midpoint below, as this is the level you're taking the trade, basing the trade on. Okay, so here on the 9:32 a.m. candle, we close above YDH, but here on the 9:36 a.m. candle, we have a hit of the PMH level. 28,976. That is a profit at $20 per point on regular E-mini contracts of $985. Or the equivalent would be 10 NQ micros to one regular E-mini. So one regular E-mini is $20 per point. 10 micro NQs would be the same equivalent. So they're $2 a point. 10 of them is $20 per point. Here on the 9:44 a.m. candle here, we have a hit of the R1. That's your regular scalp. Your regular scalp exit here, 29,013.25. That is a profit at $20 a point on regular E-mini of $1,730. Now, as far as exits, what you can do is you can either place your sell to close exactly at the level. So in this case, 28,976 even, 29,013.25. You can also look at this as a zone. So you could go one to 4 ticks above or 1 to 4 ticks below. 1 to 4 ticks above or 1 to 4 ticks below. Generally speaking, if you're on a bullish trade, it's generally going to be better to, if you're not going to do it at the exact level, to defer on the side of caution, and that would mean to go 1 to 4 ticks below. So getting out early if you're not going to set it at the exact level. Other traders prefer to put it a couple of ticks above. Every trader's different. I'm just giving you my opinion on what we feel is best to do. However, it's still up to each trader to make up their own mind through their own preference and risk profile as to what method they prefer through use and practice. On bearish trades, then you would want to do 1 to 4 ticks above because you're going down. So you would either put it at the level, let's say if this was a bearish trade instead and our scalp only exit was here, you would either put it at the exact sell to close at the exact level or defer to 1 to 4 ticks above. Or alternatively, for those traders that prefer that if you're trying to push a little more profit, you could go 1 to 4 ticks below. The whole point I'm trying to make is that you can look at this as a zone as opposed to just it's only got to be sell to close at this exact level. You can go and look at this as a zone, 1 to 4 ticks above or below for each case, bullish or bearish. Okay, now what about a regular trade? We've gone over the two different types of scalp trades. What about a regular trade? A regular day trade is going to differ from a scalp trade in a couple different aspects. One is that a regular day trade has two different alternative minimum thresholds. We have the absolute minimum required threshold, which is a 1.5 level move in your favor. And then we have the minimum ideal 2 level move in your favor. Now, why two different thresholds? Two different thresholds on regular trades because on 80% of the sessions that you'll see for SPY, QQQ, SPX, NDX, ES futures, and NQ futures, in a normal year, in a normal volatility environment, in about 80% of the sessions, you're going to see most sessions be contained within a 2-level extension above to 2-level extension below the BBKPL. The other 20% of the sessions that you'll see in a normal year in a normal volatility environment will struggle to get to R1 down to S1. So they will struggle to be just basically within this range. They'll be very compressed, choppy, lower volatility, mean reverting type sessions. The other part of the 20% of the sessions will be sessions that go above R3 or below S3, and those will be the higher volatility sessions. So the majority of the sessions are going to be contained at least on those symbols that we outlined, which are basically different structures of Nasdaq and S&P 500. So SPY, QQQ, SPX, NDX, ES futures, and NQ futures. The majority of the time, it's going to be contained within a two-level extension above to two-level extension below. Therefore, the minimum required threshold for a regular trade is the 1.5 level move. The ideal minimum threshold is the 2-level move. Now, with any one of those two alternatives, you have several different options as to how to manage your trade that differ from a scalp trade. Just like with a scalp trade, you can simply just exit 100% of your position, as we talked about, using these as a zone again, either using the exact sell to close, the exact level, or one to 4 ticks above or 1 to 4 ticks below. In either case, bullish or bearish. And at that point, when you're selling to close 100% of your contracts, just like with a scalp, and you're getting more profit, obviously, because it's an extended move than what the scalp was. However, beyond that, you also have additional options as to how you can manage your trade from that. And what that really boils down to is how many contracts you're trading. So some people prefer to trade, say, 10 micros as opposed to one E-mini, one regular E-mini, for several different reasons. Some people like to scale into their positions and then scale out of the positions. Some people will like to get into micros because of the fact it gives them more flexibility in how they can exit and manage their contracts. Whereas with regular E-minis, it takes quite an account, especially on Nasdaq. It takes a fairly large account size to trade a lot of different contracts that are just regular E-minis. So if you do have that kind of account size, everyone's account size is different. Everyone's net worth is different. So and everyone's liquidity and everyone's available cash to trade with that's not going to interfere with their lifestyle if they happen to make losing trades is different. So it really just depends on where you're at. So some people are content with just trading 1 or 2 micros. Some people just like trading one regular E-mini. Some people like trading 3 to 5 or 10 lots of regulars E-minis. And some people prefer, for example, just trading 10 lots of micros because it's pretty clean and simple. It's also the equivalent of trading one regular E-mini. So with that in mind, the second option that you have is that instead of exiting 100%, you can simply adjust your stop loss to break even or break even plus a profit buffer and keep all of your original position at the minimum threshold, whether it be the 1.5 level move or the 2-level ideal move. One thing you just have to keep in mind between these two thresholds is that at 80% of the sessions in a normal year in a normal volatility environment have a 2-level extension being the majority of the time. That is going to be the extent. Anything beyond a 2-level move that you're holding on to as far as any runners, you need to be very careful as far as your management of those positions. It's just as far as managing your stop loss on those. So once you start exceeding the 2-level move, never know if we're going to get a 2.5, 3-level move or even a 6-level move or beyond a 6-level move, because news can always come out, especially now we have the war going on, etc. So what you're just trying to do is create a repetitive process as far as how to manage your trades effectively, so that when you happen to have a session that gains more in your favor and you have some remaining runners left over, then you can take advantage of that should it move beyond the 2-level move in your favor. So the second option again is that you are moving your stop to break even or break even plus an initial profit buffer above break even. So when we started out the entry, we're utilizing a level, either a tight stop loss level or the midpoint level for the standard stop loss on a trade from this level here in a bullish trade. When we are adjusting the stop loss to break even, what we're doing then is we're adjusting the stop loss to the executed price that we paid for the position. So in this case, that would be the 28,926.75. Or we're adding a profit buffer on top of the break even. So the amount of profit buffer is just going to vary per trader. That's up for each trader to decide for themselves if they want to do something besides and on top of break even. So in this case, remember that you are doing this adjustment either here or at this level here. Because on scalp only trades, you are exiting 100%, whether you're doing a micro scalp and getting out here at the PMH level, as we talked about, or getting out at the R1 level on a regular scalp. So if you wanted to just simply go by ticks, then you could add somewhere between, say, 4 to 16 or 20 ticks. That would be somewhere between 1 point to 5 points. That would be kind of a minimal profit buffer on top of break even. If you wanted to go more by levels with this structure here, then remember our entry was here on the close of this candle. So moving it up to at least YDH or PMH would be good in this particular thing, especially in this market structure scenario in which we saw that the YDH and PMH were very critical levels for this particular market structure. So if you did not want to do a minimal profit buffer add-on of, say, 4 ticks to 20 ticks, that's 1 point to 5 points, then figuring out which levels you basically want to go at the maximum you'd want to do would be R1. So that would be the scalp level below, the regular scalp level below the mid R1, R2. So that would kind of be the maximum profit buffer on this as far as adding on top of break even if you wanted to move it up to R1. Whereas these would be more in between, say either the PMH or the YDH, with the bare minimum being just adding 4 ticks to 20 ticks. Now what about the third option? The third option is going to only be available if you're trading 3 or more contracts, whether it's 3 or more regular E-minis or 3 or more micros. So this goes back again as to why some people prefer to trade, say, 10 micros as opposed to one regular E-mini, because this gives you the flexibility as in this particular case. And on this particular option, what you're doing is that once price gets to either one of these thresholds on a regular trade, you're then closing out and exiting somewhere between at least 60% up to 90% of your original position. And then you are then on the remaining runners adjusting your stop loss to break even, the price that you executed your initial position at, or break even plus an initial profit buffer, whether you're going to use the minimal profit buffer or the profit buffers that we talked about here, with R1 in this particular case on this particular trade being the maximum. Okay, so as an example, if you have 3 contracts and you close out 2 and that leaves 1, that's approximately 65%. If you have 5 and you close out 3, then that's 60%. 5 and you close out 4, that's 80%. If you had 10, Close out 6, that's 60%. Close out 7, that's 70%. Close out 8, 80%. Close out 9, that's 90%. Then the idea after that is that as price continues to move in your favor, at each succeeding level move in your favor, which each succeeding level means either a midpoint level or a main key level. It does not mean a QL level. It's either a midpoint level or a main key level in your favor. Now, a contextual level also counts if it happens to be in the pathway after the minimum 1.5 level move threshold. So if any of these levels were beyond and up here, as an example, then those would also count as additional waypoints. So additional waypoint meaning as price continues to move to the next key level in your favor, at that point you either add more profit buffer to any remaining position that you have, locking in more profits, or exit all of your remaining position, or do a combination of adjusting your stop loss and also exiting some of your remaining contracts, leaving some runners, and then as price continues to move on in your favor again, you can do the same thing over and over again until you finally decide to exit all of your remaining contracts. Okay, so here on the 948 candle, we have a hit here of the mid R1, R2 at 29,067.25. That is a profit of $2,810 per regular E-mini contract or per 10 micros. So for example here, if you had 10 micros and let's say you sold 9 of them, then you'd be getting 90% of $2,810. You're leaving 1 micro, adjusting the stop loss on that 1 micro either down to R1, PMH, YDH, or just adding simply 4 ticks to 20 ticks to that 1 remaining micro. Or you are on the other extreme, just closing out 60% of them and closing out 6 of the micros. And then on the remaining 4, you're doing the same thing. You're either adjusting your stop loss to break even or break even plus a profit buffer, either being R1, PMH, YDH, or the 4 tick to 20 ticks as we talked about. Then as price continues to move in your favor, when it moves up to R2, keeps moving up and keep moving up. Then if you say, for example, you had 4 left because you closed out 6, then as an example, you could close out 1 here at R2, 1 here at mid R2, R3, and all the remaining ones here at R3 as an example. Here at 10 a.m. we have a hit of the R2 level. That's the minimum ideal 2-level move, 29,121.25. At this point, each regular E-mini contract that you would have left at this point is $3,890 profit from the original position entry at 28,926.75. As we talked about earlier, you don't really know on any given day if price is going to continue to move in your favor, or is it just going to simply retrace back down, or is it simply just going to move sideways the rest of the day. So having a system where, as we talked about, when it hits the 2-level extension away from the BBKPL, then that is the time that you want to start really tightening up your stop loss on any remaining position that you want to keep. That way, if it does start reversing and going back, you're still going to have the majority of the profits on those. If it does happen to keep moving in your favor, then as it hits each succeeding level move in your favor, then you can make a further adjustment, either selling some or all of and closing out some or all of your remaining runners. If you just close out some of them, then on any remaining position, then you just further adjust your stop loss in your favor. Okay, so if you did have any remaining runners, then as you can see here, we have a hit of the mid R2, R3 here around lunchtime. At this point, that's a hit of the 29,229.25. You're now at $6,050 profit per regular E-mini contract. Finally, end of day here, 3:58 p.m., right before the RTH session close. We do get a hit right here of the R3 level, 29,337. Any remaining runners that you had going into this that were regular E-mini contracts now would be, this is about 410 points, so that's basically $8,200. So as you can see, if you have a system where it allows you to still participate after a move in a two-level move in your favor, where you can still participate. There are some traders that just like to adjust their stop loss, and they like to go for it all and try to exit everything at maximum profit, and that's fine. However, there's simply going to be days where that doesn't work. And like I said, there's going to be about 80% of the time a two-level move is going to be the extent of the move. Now, that doesn't mean it's going to just dead stop every time on R2 or S2. It can simply go above. So something like this is more about what you see. So a move up to here and maybe a little shoot above, goes back down, and then maybe the rest of the day it either trades sideways or starts going back down, maybe to test the bull bear KPL again. Or some days you'll get double volatility where it'll all of a sudden not only go back down, but then it also goes down to S2, and then it'll go back up to the bull bear key price level again, and maybe back up to R2. So sometimes you get these wild volatility days where it just yo-yos back and forth. The point is that the majority of the sessions, the R2 to S2 is what it's confined between. So it's best in the long run, even though you can get lucky on some days if you decide to just adjust your stop loss, hold on to all of your contracts, and just see where it ends up, see how high or how low it can go if you have a bearish trade, or how high it can go on a bullish trade. And that's fine. However, that's not really a repeatable system. So the scaling out of your contracts at the thresholds of 1.5 to 2 levels, and then moving your stops and or scaling out of remaining runners at further moves in your favor over time performs better than just going for 100% all in, trying to get maximum moves on every single session, because it's just not realistic. And so that's why you have to keep in mind it's just best to have a system in place that if you're going to do regular trades, that you practice scaling out, adjusting your stops, and taking profits as you get further moves in your favor. Now, if you're just using this indicator for scalping, that's a completely different mindset. Scalps, as we talked about, you have two different types of scalps. You have micro scalps and regular scalps. So, you can do scalps, you could do multiple scalps, you could do a scalp off of the BBKPL to R1, then do another trade from R1 to R2, and then another trade from R2 to R3. If you are doing trades off of the other levels, as we talked about, as an example, you simply can go into the user control panel, and depending on whether you like to use tight stop losses or uh, standard stop losses, if you like to use tight stop losses, then you could simply turn on the QL levels. In this case, QL levels below, since this is bullish move is seen by the ribbon all day. So if you were going that route, then you would use the tight stop losses for continuing scalp trades off of each particular level. If you're just going to use standard stop losses, then it would be the midpoints below the level in question. So if you're taking a bullish trade off of R1, then mid BBKPL R1 for the standard stop loss for the bullish trade off of R1. Again, you have the ribbon being all green here with the close above R1. So with this indicator, you do have multiple opportunities on a lot of days for trading lots of different levels. It just really depends on what your preference is, whether you like taking trades from the opening 9:30 a.m. candle, whether you prefer taking trades off the PML, PMH, YDH, YDC, or YDL levels, or whether you prefer letting the session play out some and then picking and choosing specific points and specific other key levels such as the main R levels or S levels to take trades from later in the session. Of course, with any bullish or bearish trade, as we've talked about, any bullish or bearish trade on any close above a key level or a contextual level or close below a key level or contextual level needs to be confirmed by the ribbon indicator, as we went over with in the beginning of this video. So we're not just going on simple closes above or closes below levels. It has to be confirmed by the ribbon indicator. So that's another important thing to keep in mind. Okay, so hope that you've enjoyed this video. If you are interested in purchasing this indicator, the futures CFD's daily key levels V3.0 indicator, you can send us an email at daytradinggps@gmail.com to request a discount promo code for a substantial discount on the purchase of that indicator. If you'd also like to purchase the ribbon indicator, you can also send us a request for that as well. If you'd like one for both, please include in your email that you're requesting the promo code for both of the indicators. We also have daily key levels indicators for SPX index, Nasdaq index, stocks and ETFs. So if you prefer to trade SPY and QQQ and major stocks like Tesla, Nvidia, etc., then our Stocks ETFs daily key levels indicator. We also have a Forex and cryptocurrencies daily key levels indicator for those that like to trade Forex currency pairs and cryptocurrencies. Okay, so that's going to wrap it up for today's video. We're going to close out the video by showing you user reviews and feedback that we've received from traders who have purchased the indicators and use them on a daily basis. So for those of you who are wondering how the indicators are working for the people who have purchased them and used them, we'd like to show you some screenshots of the reviews and trader feedback that we've received. You can also see the trader feedback and reviews by simply going to daytradinggps.com and then clicking on the reviews. So again, thank you for taking your time for watching this video today, and we wish you much prosperity in all your future trading. Okay, so for those of you who might be wondering, well, how is this working for people that have purchased the daily key levels indicators? You can go to daytradinggps.com and look at the user reviews and feedback. We've just taken some of them here and highlighted parts of them, but we invite you to go to daytradinggps.com and look at the reviews and trader feedback on our various daily key levels indicators, including the SPX daily key levels indicator. Thank you.